which is another very testable area in the exam. The examiner tests this part of your syllabus also often, and we're going to look at past questions to expose you to more areas. And the topic or the standard we're looking at today is IAS 37 that looks at provisions, it looks at contingent liabilities, and also contingent assets. So today, by the end of this class, in fact, the objective of this standard is to determine the recognition, measurements, and the appropriate disclosures for provisions, contingent liabilities, and contingent assets. So majorly, what I want to discuss with you is how to recognize, how to measure, and the disclosures that you're expected to put in the notes to the financial statement in respect of provisions, contingent liabilities, and contingent assets. Now, I would pick them separately because there are three separate items: provisions, contingent liabilities, and contingent assets, three separate items. So I will start with provisions. And according to IAS 37, provision is a liability of uncertain timing and amounts. So according to IAS 37, provision is a liability of uncertain timing and amount. So we have a liability, but we are not certain. We don't know when we are going to incur that liability. We don't even know the amount as of now. We are not sure how much it will be. So looking at this definition, it becomes, it poses a little challenge with regards to putting it in our books, recognizing it in the books. Because we are saying, yes, it's a liability, but when we incur it, we cannot say. How much is it? We don't know. We cannot say for a fact that this is how much we are going to pay. So, I mean, there are a lot of circumstances that can result in this. And a typical one is if a company is having a court case, if there is a present court case on the company. So in that regards now, they don't know when they will pay. They don't know how much liability they would have to pay, right? And there were series of examples that we can look at in these regards. Another one is if a company has to do something, maybe we call it the commissioning liability, where you would need to remove an asset in the future and spend some amount, right? We usually make provision for that because mostly the timing might not be so certain, and the amount we would incur is also not so certain. So we would look at series of examples and we will find a way on how to recognize and measure these items, even though the time when we are supposed to recognize it is not, we are not sure. The amount we are supposed to recognize, we are not sure. So how do we then recognize it? So that's what we are going to go into very quickly. But before then, I need to mention that provisions is different from trade payables and accruals in the sense that for these other liabilities, we can ascertain the timing and the amounts reliably. We know for trade payables now, you know when you're supposed to settle. You know how much you're supposed to settle. So that's that's a difference from provisions. But again, is there any difference? This is a little deviation. Is there any difference between trade payables and accruals? Can anybody in this class actually tell us what's the difference between trade payables and accruals? Can anyone try that one? Trade payables and accruals. Because of our time, so trade payables is the amount owed for the purchase of goods or services on which the entity has received an invoice from the supplier. So it's the amount you owe for goods or services you bought, and you have received an invoice from your supplier. But accruals, though the same, almost the same with trade payables, the only difference is that for accruals, you have not received the invoice from anybody. So is the amount owed to a supplier for services enjoyed by an entity, but for which invoice has not been received, or it might not even never received an invoice, and you might receive. That's why if you are owing salaries, for example, now, we call that accrued wages, accrued salaries. Or probably you used electricity for the year. You used for electricity for a whole year. And let's say you have not gotten an invoice from the electricity provider. That's an accrual. So that's just a thin line of difference between accruals and trade payables. And based on IAS 1, trade payables and accruals, you see them, they are lumped together as a single line item in the account. They are just treated as trade payables and accruals in the account, but there's a thin line of difference between them. While for trade payables, you have received the invoice. For accruals, you haven't received an invoice, but you still go ahead and put it in your books as that you are owing it. Okay, I needed to mention that. Now, back to provisions. You see, provision is a liability of uncertain timing and amount. Then if the timing and the amount is uncertain, then how do you then recognize provision? IAS 37 says that for you to recognize provisions, it must meet three criteria. And number one is that there must be a present obligation as a result of, there must be a present obligation as a result of past events. Number two is that it must be probable that that there will be an outflow of resources embodying economic benefits. The major thing here is that it is probable, must be probable that there will be an outflow of resources. It's not probable. And when we say probable, we are talking about more likely than not. Is more likely that it will happen. That is, the probability is well above 50% that you will have to pay money or you outflow resources. Then that's what we mean by it must be probable. And number three is that the obligation must be capable of being measured reliably. So in the exam, you'll be required to write these recognition criteria a lot of time. Nobody is asking you to write this verbatim. At any point in time, you are not supposed to write all of these things word for word. But there are certain words and phrases that we want to see in each of your points. Like this one that's talking about present obligation. There has to be a present obligation. That's the most important point in this first one. Number two, it must be probable. This probability is important. You must understand that it is probable that there will be an outflow of resources. That's the key thing here. And also that the obligation, you must be able to measure it reliably. And in the first point that talks about present obligation, you already know, according to conceptual framework, that an obligation is like a duty to do something, to act in a certain manner, and in which an entity has no practical ability to avoid. And if you have to do something, and that thing you cannot avoid it, you must, then you have an obligation. It's not something you cannot. You have no practical ability to avoid it. Now, the obligation here, we are saying it must be present. It must be present, meaning the obligation exists as of today. It's not like you are planning to do something in the future. You are now saying you have obligation now. No, that thing must have happened. That's giving rise to you doing something. Present obligation. And you see, this present obligation can either be a legal obligation or constructive obligation. Either one is fine. Either is a legal obligation or it is a constructive obligation. If it is a legal obligation, it means that if you don't do it, somebody can sue you. If you don't do it, there will be legal consequences. You have signed a contract that you will do something. That's a legal obligation. But for the constructive obligation, you did not sign contract with anybody. Just that as a result of your past practices, as a result of your public statements and actions, you have created valid expectation in the mind of stakeholders that you will do something or that you will act in a certain manner. That's a constructive obligation. Imagine as a company, you are in the oil and gas industry and you are into the upstream where you drill. And every year, you usually clean up the environment that you have messed up. You clean it up every year. You see, even if you don't have an agreement with anybody that you have to clean up, you see that cleanup cost every year, you have to, you have an obligation for it. Because if you don't do it in a particular year, it becomes an issue for you, especially in terms of your image and in terms of your past actions. You have always done it. So you have created a kind of expectation in the mind of people that you will do it. That is a constructive obligation. So either of these two can pass as a present obligation. And I've already mentioned the issue around probability, that it means that it's the occurrence of that event is more likely than not, meaning the probability is above 50% that you will pay money. So that's probable. That's probable. Now, before you can recognize a provision, all of these three must be present. All of these three must be present. If anyone is missing, then you cannot recognize a provision. Cannot recognize a provision. So before I go to measurements, let's look at some questions on recognition just to apply these three recognition criteria. Then we'll go to measurements. Now, the first question, this talks about a company is planning reorganization. They are planning to reorganize their organization. These plans are in an early stage. Can the company create a provision for the reorganization? In this case, can the company create a provision? Now, number one, the question is this. Is there a present obligation? No. See, there is no present obligation because the company is still planning. And the obligation does not exist. At the moment. So it has, as soon as it doesn't meet one, that's it. Therefore, it cannot create a provision for the reorganization. Cannot create a provision for it. They are still planning. Another one is, it says the Prince Properties owns a series of high-rise modern office blocks in several major cities in Nigeria. The government introduces legislation that requires toughened safety glass to be fitted in all windows on floors above the ground floor. The legislation only applies initially to new buildings, but all buildings will have to comply within 5 years. Can the company recognize a provision? Let me give you opportunity to attempt this. Is there anybody that would like to attempt this? Can the company create a provision? For this one?
Hello, sir.
Yes, Omomi.
Okay, can I try?
Yes, please.
Okay, from this question now, I think there's a present obligation for this company now, as in to build this, to have these new buildings. So, and this will yield economic benefits, I guess. So, and it can be measured. At least the cost of these buildings can be ascertained. I don't know if I'm
Okay.
correct.
Sir, can I try?
Yes, Rita, please, can try.
Sir,
We
can
can hear
I
you.
try?
Yes, please, you can try.
Um, this question meets the two conditions, but it cannot be reliably measured since we don't know the amount.
Okay. Since you don't know the amounts. All right, that's a good trial as well. So let's look at it. Let's give it a closer look. So this company owns high-rise buildings. So the government then came up with a legislation that requires toughened safety glass to be fitted in all windows. So the government says that everybody that is using high-rise, so all of you, you must change your glass into another type of glass that is stronger than what you are using before. That's what the government is saying. And they now came up, and it's a law, it's a legislation. So the legislation applies initially to new buildings, okay, but all buildings will have to comply within 5 years. So apparently, since the prince already owns the building, so is not a new building. That means before it can apply to him, he still have 5 years to comply. Okay? So considering that the prince has 5 years to comply, this shows that the obligation exists in the future and the entity has no present obligation. Additionally, the prince can decide to sell the building and avoid the obligation totally. So you see, that is what we are, that's what we say when we say obligation. is not something you can avoid. For you to say, yes, there's an obligating event, it means you have to, there is nothing you can do to avoid it. But in this case now, before the prince will comply, is in the next 5 years. So the obligation only exists in the future. It has no present, the entity has no present obligation. And its future action can even change everything, because it can decide to sell the building and avoid the obligation totally. So as it is right now, the prince therefore has no therefore cannot recognize a provision. So you see, the important thing that you need to identify first is there a present obligation before you think about the rest? If there is a present obligation, then there is high likelihood that we might be able to say, okay, are we going to pay money? Do we know how much we can pay? Can we measure reliably? All of that are a matter of judgment to a large extent. But the one that we can see clearly is that obligating event. Is there an obligation? So those that attempted, fantastic, you did well. So let's look at another one. So this is talking about Lugard Limited. It says he operates in a country where there is no environmental legislation, and its operation causes pollution in the country. Lugard has a widely published policy in which it undertakes to clean up all contamination that it causes, and it has a record of honoring this published policy. Is there a provision? So can it make a provision? Can you attempt this?
Yes, you can make a provision.
Okay. Why?
Due to that, he has a present obligation which is constructive as a result of this thing, past events, and also since he has this thing, I think he has undertaken this kind of cleanup before, so they will probably have a cause for it. So that is hello?
Yeah, I'm with you. I'm with you. Made him. Okay. Very good. Very good. Very good. Very good. Any additions from anyone? I saw one hand up. Charity.
Can we try?
Okay, go ahead, please.
So, Lucas has a policy that he cleans up all the contamination that it causes in the course of his operation. And he has been honoring this policy. This is a constructive obligation. But he can still avoid to allow his operation to pollute the environment. And then again, there is no environmental registration that can hold him accountable for the pollution caused. So I think there is no provision.
Okay, okay. Good trial. Good trial. Okay.
Can I try?
Yes, please, Tony.
I think it has an obligation, reason being that it is being stated as part of his policy. I think it's an obligation on them. So, of which it has been stated there that, and even though people will have read their policy, that's part of what they would do. So it can give them bad reputation if they did not honor their policy. Thank you.
Good. Good. Okay. So, you guys are correct. Even though from this question, there is no environmental legislation, meaning that there is no legal obligation, but this guy has made a widely published policy that he will undertake cleanup costs. So even though there is no legal obligation, there is a constructive obligation. So that obligating event exists. There is a constructive obligation here. So as a result of that, we can ascertain the resources. As a result of that, it is probable that an outflow of resources would be required because he has always claimed it, he has always mentioned it. So he would pay. There will be an outflow of resources, and the obligation can be measured reliably. Now, when we get to measurements, I've not really taught you. Measuring reliably here does not mean that you know the precise amount. It's just an estimate you would make. But here, there is therefore Lugard can create a provision for this transaction. In this case, because there is a constructive obligation, and it's probable that there will be an outflow of resources, and the obligation can be measured reliably. So you guys are absolutely correct. The next one, this talks about Alibat Limited. He said it gives warranties at the time of sale to purchasers of its products. Under the terms of the sales contracts, the company undertakes to make good any manufacturing defects that become apparent within 3 years from the date of sale. In the period, it has sold 250,000 appliances and estimate that about 2% will prove faulty. Will Alibat recognize a provision? What do you think? Can you recognize a provision in this case?
Yes,
Okay. Where
because
is your event now?
I think there's a legal obligation.
There is a legal obligation. Where is the legal obligation? Is there anywhere here that shows there's a legal obligation?
That is, I would say the sales contracts for giving customers warranty.
That's absolutely correct. There is a sale contract that shows that the company will provide warranties to its customers. This shows that there is a legal obligation. So for the other two, we cannot decide that conveniently, but we can assume that there will be an outflow of resources which can be measured reliably. Therefore, Alibert Limited can make a provision. In the exam, they will give you a complete picture. They will ask you to calculate the provision. You will see the scenario in which that you yourself, you will know that, this company will pay. In this case now, this company, it shows that this company will pay because it has sold 250 appliances and they're estimating that 2% will be faulty. So there is an outflow. They can even measure it to a larger because they know that 2% will be faulty. It's just for them to then know, okay, what warranty, what's the repair cost, something like that. All of those details will be given to you in the exam. But for now, at least, you can identify an obligating event. So let's do the last one. For those of you that have not participated, better participate in this last one because these are the questions you find in your exam. They are just extract of questions I've seen in your past questions. I'm just bringing out. This one says on 31st December, Just Engineering decided to close a factory. The closure will lead to 100 redundancies at a significant cost to the company. At December 31st December, no news of this plan has been communicated to the workforce. Will the company recognize a provision? Will the company recognize a provision? What do you think?
Can I try?
Yes, please.
For me, they will not recognize the provision because there is no present obligation. I think it's still in the future.
And that's absolutely correct. That's absolutely correct. They cannot recognize a provision here for a lot of reasons. And number one is this. They are still, yes, they have decided to close the factory, but who says they cannot change their mind? Okay. But the major reason why this obligation does not exist right now is because they have not communicated. No news of this plan had been communicated to the workforce. You know that if they had communicated it, that one is another thing entirely. There is an obligating event at that point. But the entity has not communicated its plans to the workforce. Hence, an obligation present, obligation does not exist. Does not exist and cannot recognize a provision. Okay, so we have looked at like 5 or 4 scenarios. For provision, this recognition criteria, you have to be comfortable with it. There is no question they will ask you on provision. You are required to almost at every point in time, you should be able to state these criteria. Nobody is saying cram it, But at least you must know that there must be a present obligation. Resources will be outflowed, and we know the amount of that obligation. We can estimate it. Those three are very important for you. Now, what about measurements? Because the issue with provisions, right, is that the amount is uncertain. We are not sure how much we will spend. So, and we need to recognize that event in our books. So how much should we put it in our books? You see, a lot of organizations, not with IAS 37 anyway, IAS 37 has blocked all those loopholes. Before now, you will see organization using provision to engage in creative accounting or window dressing. You will see them making unnecessary provision, making huge provision, probably in a period where the company is doing so well, they are making huge profits, and they want to undermine that profit. Probably maybe they don't want to pay dividend, or for whatever reason. They want to undermine that profit. You see them making a big bad provision on an issue. But with this standard, where we need to be sure that there is an obligating event, all those has been eliminated. But still, very smart accountants are still using some of the loopholes to engage in creative accounting using provision, because that room is still there. Look at it. Look at what this standard says. It says that provision, look at it, provision is measured at the best estimate. You see? Meaning that we don't know how much. So just make the judgment and determine how much it is. So it's measured at the best estimate of, look at it, the future expenditure required to settle the obligation. So who then becomes the judge of best estimate of future expenditure? So that loophole is still there, and it will continue to be there. And that's why taxman is part of the issues we discuss in deferred tax. That's why there is always a timing difference. Taxman will say, no, me, I'm not allowing this. Also, what's the meaning of that? Taxman does not work with estimate. He works with cash flow. That's what taxman will tell you, no, I'm not going to allow this as deduction. When you pay the money, come and allow it, come and take the deduction. Then they are giving us more work. We have to make, that's a temporary difference. So back to this one. For now, you need to learn this, because that's the requirement of IAS 37 right now, that the amount you recognize as provision can only be the best estimate. If you ask me what's best estimate, well, the standards say that these estimates should be based on the judgments of the management, supported by previous experience or past experience of similar transactions or events. So we are saying that okay, make best estimate. We are not saying this best estimate, use your judgment. And when you are using your judgment, base it on your previous experience. Okay, what if you don't have previous experience? What if you don't have previous experience? So, I mean, there's really nothing we can do. Just make judgments. Just make judgment. So that's why you find people using it to create and window dress their books, because for me, this is still a loophole. It is now left to the auditor that is auditing your company. If you're able to convince him on how you have determined your estimates, then okay, then fine, it will be okay. So now you see these events that we are saying you are making provision for, it could be, let's say, you have a court case, or you have a customer that is about to go bankrupt, or it could be just a single event. So if it is a single event, then your estimates will be based on the most likely outcome. So you just say, okay. Let's look at 50% or 75% chance that this will happen. And let's assume the amount involved is 100 million. Just do some 5% of 100 million, something like that. So it's much more difficult in practice. In the exam, they will give you all these figures that you require. And it could be a situation whereby there are multiple events, like giving a warranty to customers that you have sold a lot of goods. So how do you determine the best estimate of the future expenditure required to settle in that case when you have multiple events? Again, in that case now, that means there would now be some probability. In fact, the standard says use expected value, meaning the examiner will give you probability and the number of people that might return and also the amount. So I will show you how to determine probability. So I'm saying that if the obligating event is a single event, the best estimate is determined by considering the most likely outcome. What's the most likely outcome? But if it is a multiple event, obligating event, the best estimates will be determined with the expected value. So be required to use an expected value. So that's measurements. That's how we measure provision. So again, for your exam, you have to know this. So what I've mentioned, I'm not sure it's up to 4 sentences. This is the 4th sentence. Best estimate of the future expenditure required to settle. This is the 2nd sentence. The estimate should be based on judgment of the management supported by previous experience of similar transaction. Then 3rd sentence, 4th sentence. So I don't see why you should not be able to tell the examiner all this in your exam. Now let's solve questions, please. Let's solve questions on measurements. I have plenty of questions here. I hope we can finish everything. I don't want to do this another day. So I need somebody to be reading for us so that we can move faster. Who is going to volunteer? Ifua, is Ifua around?
Yes.
Okay. All right. Let's go.
Okay. Question. Traffic Limited has won a contract to provide temporary accommodation for workers involved in construction of a road. The contract involves the erection of accommodation blocks on a public park, and 2 years later, the removal of the blocks and the restatement of the site. Traffic Limited estimates that the task of removing the blocks and reinstating the park to its present condition might be complex or straightforward. If complex, it will result in a cost with a present value of 4 million naira, or if straightforward, it will result in a cost with a present value of 2.6 million naira. The entity estimates that there is a 60% chance of the job being straightforward. Should a provision be recognized, and if so, what value?
Thank you very much. So for this one now, there is this guy, he won a contract, right? And he's supposed to provide accommodation for workers involved in construction. And this contract requires that he needs to erect accommodation blocks on the public parks, and 2 years later, removal of the blocks and the reinstatement of the site. Okay. So he's not trying to estimate the task of removing the block and restating the park to its present condition. And he's saying that it could be straightforward or it could be complex. If it's complex, he will spend 4 million at today's value. If it's straightforward, he will spend 6 million. So there's a 60% chance that it will be straightforward. So you see, this one is clear that there is an obligation because he has won a contract. Okay. So there is a present obligation because the entity has been awarded the contracts. So with this present obligation now, and of course, all the other criteria here are met. There will be outflow of resources. You can even measure it reliably, right? So should a provision be recognized? Yes. So there is a present obligation. Also, there will be an outflow. There will be an outflow of resources and the obligation can be measured reliably. So, therefore, the entity should recognize a provision. So you can recognize a provision. That's not the question. So at what value? So provision are measured at the best estimates of the future expenditure required to settle the obligation. So in this case now, there is a single event, and the best estimates will be based on the most likely outcome. Because the single event is that we need to remove the site or that accommodation blocks for our workers. We need to remove it. That's a single event. So we would need to consider the most likely outcome. And there is a 60% chance of the job of removing the structure being what? Straightforward. So following from the above, the most likely outcome is the job being what? Straightforward. And we'll make a provision of how much? 2.6 million, because if it is straightforward, the present value is 2.6 million. So that's this one. Do you have any question, or we move to the next question? Okay. Next question, please. Who is reading this? Okay. I have to continue because I will still send this, I'll still send this to you. So who is reading this? Please read I for.
Excuse me, sir.
Yes, mommy.
Sorry, please, before you proceed, I didn't get the explanation on that single event. Will you please take it again?
Oh, okay. So the obligating event is the removal of the structure. We need to remove, because here the question say we would provide temporary accommodation for our workers. And we'll need to remove that the contract involves the erection of accommodation blocks, and 2 years later they will need to remove it and reinstate the site. So that's the event. That's what the obligation is all about. So that's what I mean by single event. Okay. So whenever there is a single event like that, meaning the obligation is relating to just one event occurring, which is us removing the site, then just look at the most likely outcome. And the examiner has given you different outcome. Is either this removal will be straightforward or complex. If it is complex, we spend 4 million. If it is straightforward, we spend 2.6 million. And this is where the answer is. There's a 60% chance of it being straightforward. That means being straightforward is the most likely outcome. And that's why we are making a provision today of 2.6 million.
Okay, thank you, sir.
You're welcome. Please, let's read the next question.
Okay. Alibat Limited has sold 5,000 units in a year. Sales accrued evenly over the year. It estimates that for every 50 items sold, 10 will require small repairs at the cost of 15 naira each. 5 will require substantial repairs at a cost of 200 naira each, and 5 will require major repairs or replacements at a cost of 400 naira each. On average, the need for a repair becomes apparent 6 months after a sale. What is the amount of provision that will be recognized?
Okay. Let me ask you, if you read this question again, it sold 5,000 units. Sales accrue evenly over the year. When they tell you sales accrue evenly over the years, it means that it sells the same amount of units every year. That's what they mean. So, you now say for every 15 items sold, 10 will require small repair at the cost of 15 naira. 5 will require substantial repair at the cost of 200 naira. 5 will require major repair at the cost of 400. On average, there is a need to repair becomes apparent 6 months after sale. What's the amount of provision? So, is this relating to a single event or a multiple events? Can't tell me. Is this a single event or a multiple event?
I think it's a multiple events.
There is a multiple.
It is a multiple event because we are selling to plenty people, plenty, and you will have obligation on each of them. So it is a multiple event. So we would need to, and when you have multiple events, you would most likely have to use expected value. You most likely have to use expected, and expected value is like they'll give you a probability, then you use that probability to calculate how much you will spend. So if you look at this question now, the way it's structured, it says that we have 50 items sold, that for every 50 items sold, that 10 will require repairs. For every at the cost of 5, and 5 require substantial repairs. So let me, no items, let me do repairs. So there is a repair that is a small repair. There is the one that is a substantial repair. And there is one that is major repairs. So to get expected value, you would use probability. So there's a probability that for every 50 sold, 10 will require small repair. So you do 10 over 50. So what's 10 over 50? Can you do the math? What will it give you? That's 20%, if I'm right. Five will require substantial repair. That's 5 over 50. That should be 10%. And how many again?
5.
And 5 require major repairs. That's 5 over 50 again. That's another 10%. So the costs of each of them. For the first one, since we have 5, so how many items? How many items will require small repairs? How many items will require small repair? Since we are selling 5,000 units, and we are saying we have converted it to probability, 20% of all our products. Ordinarily, it should have been 20% of 5,000 units. But since the examiner told us that on average, the need for a repair becomes apparent 6 months after sale. Only 6 months after sale. That means the first 2,500 units we sell, because they say that we sell evenly over the years. That means by the end of the first year, 6 months, we will have sold half. So that means 2,500 of our sales does not even have this requirement for repairs. There's no need to make provisions on those. It's only 6 months after sale that we can now be considering either there will be a small repair, substantial, or a major. That means these repairs are only impacted on just 2,500 products. For small repairs, for major repairs, or for substantial repairs, it's just on 2,500 products. And for, what's it? I can't hear you,
Hello,
Charlie.
sir.
Yeah.
Please, how did you arrive at the 2.5? I'm lost.
The total units sold is 5,000 units. And we sell the same quantity evenly over the year. Every month we are selling the same quantity. So I got this probability and all of that. So I want to know the number of items that will be exposed to small repairs. Ordinarily, I wanted to do 20% of the total 5,000 units. That is what I will have done. But in this sentence, the examiner told me that on average, the need for a repair becomes apparent 6 months after sale. So if need for repairs becomes apparent 6 months after sale, and we sell 5,000 units all through the year, and we sell the same amount every month, that means in the first 6 months, we will have sold 2,500 units. That's half of this. Those ones does not require any repairs. We don't have a liability with regards to those ones, based on what the question is telling me. The need for repair becomes apparent 6 months after sale. So it's remaining 6 months where I will sell the remaining 2,500. That is where these issues of repairs then arise. And I need to make provision. If my liability is in respect of those ones, of those 2.5. And that's why, based on this probability I've computed, the number of items that will require small repairs is just 20% of the 2.5. That's the 2.5 is the total that require repair, which is half of this 5,000. And this same year, like that. So this is 500. This is 250. And this is 250. You can still ask another question if you want to. Feel free.
I
So
still don't
5.
understand how you got the 2.5.
I will still say the same thing again anyway. So what exactly do you understand? How do you understand it? Maybe I can help you like that because I don't know another way on how to explain that. Is there
I
anybody
don't
that
get it
can
at
help
all.
us here in this class?
Hello, sir.
Hello, please, can you help
Yeah,
us?
the question said on average, the need for repairs and parenting is 6 months, but on the question is 1 year. So it's half of the year that these ones that need repairs are being captured. So it's not the full year. That's what I understood it.
Yes. So since the question says on average, the need for repairs becomes apparent 6 months after sale. So that means 6 months after sale. So um, if that's the case, then we can look at it as okay, the total sale for the whole year is 5,000. And they told me that sales accrue evenly over the year, meaning I'm selling the same amount, I'm selling the same quantity every month. That's what they mean when they say sale accrue evenly over the year. And the requirements, the need for repair will only arise 6 months after. That means half of the year, I won't have to bother about repairs or no repairs. Half of the unit I've sold, because half of the year I will have sold like 2005. So that means before any, as far as this year is concerned, before any need for repairs, anybody would complain about damages or whatever, is 6 months after that sale. So for this year, that's like half of the year. So that means anything I sell in January, for example, anything I sell in January, I don't have any obligation on that sale. Nobody is going to come until maybe maybe July. Maybe July. Anything I sell in February, nobody is going to come until maybe August. In fact, anything I sell in June, nobody is going to come until maybe December. So the obligation I have really for this year is relating to the sale I made between January and June. Those are the people I need to worry about as far as this year is concerned. You see, anything I sell in July, before any complaint will come, is the next year already. It has nothing to do with this year. So, which is why on the basis of this, we are saying, based on this probability we have calculated, don't let us calculate the amounts that will require repair this year based on 5,000 units, because only half of the year's sale will come up for repairs this year. And that's why we halved this 5,000. It's just because of this thing the examiner told us. If the examiner did not bring this 1 year, if they didn't put this 6 months here, I will have used 5,000. That, okay, there's a probability that 20% of my total sale will require small repair. 10% of my total sale will require substantial. But since the examiner says repairs only becomes apparent 6 months after sale, so that means anything I sell after June, the repairs is not happening this year, it's happening in another year because that's 6 months after. And I'm sure their warranty, even though they are not specific, they didn't tell us full detail here, but it won't cover up to the next year. It will usually be a 1 year warranty, but they didn't really give us those details. But the way I got this 2.5 is just because of the examiner told us that repairs only becomes apparent 6 months after sale. And that's synonymous to 2,500 worth of sale. Okay. Emmanuel, I saw you raising up your hand. You wanted to say something before.
No, sir, I'm not saying anything anymore. The other lady has already explained what I wanted to say regarding the confusion behind the 5,000 units and the 6 months repair expectation rather.
Okay. All right. Thank you very much. So for small repairs, there are only 500 items. And how much are we going to spend to repair items that require small repair? Say 15 naira. So 500 times 15 naira is how much? That's 2,000. That's 25,000. Abi?
Yes, 25,000.
What about substantial repairs at a cost of 200 naira? How much is that?
50,000.
What about major repairs? At which cost? 400 naira. How
100.
much is it? So, what's the total cost?
175,000.
75,000.
And that's the amount of provision. 175,000. Yeah, the equation looks short, but is a little tasking. Okay, I can see hands raised up. You can ask questions, please.
Okay, so sir, this total cost now. So are we saying that it's going to be added to be part of the current total product cost
No, that's not
before?
right.
Okay.
Just make a provision. Will debit
Oh,
expense, credit liability. That's what we're doing.
okay, thank you.
Yeah, you will see the situation where it can be added to the cost of the assets. You will see a scenario like that very soon. Okay. Let's read the next question. Ifua.
Okay, question 3.3. Alexi Limited sells goods with a warranty under which customers are covered for the cost of repairs of any manufacturing defects that becomes apparent with the first 6 months of purchase. The company's past experience and future expectations indicate the following pattern of likely repairs. Required. What is the provision required? What is the provision required?
Okay, I think this is simpler than the last one. So it sells goods with a warranty under which the customers are covered for any cost that becomes apparent within the first 6 months. So the past experience and future expectation indicates this pattern. Percentage of goods sold, 75% will require no defect. So 20% minor, 5% will require, they are major and require, so again, we'll use expected value. So the provision will be calculated as below. For the minor, we'll do 20% times 1 million. What would that give us? For the major, that's 5% times 4 million. How much is that? I hope I'm correct.
Yes, sir.
Yes, you are.
Right.
So the provision here is 400,000. Like that. So what this two question is just trying to show you is when you have multiple events where you are expecting returns from everybody. This first question is more technical in the sense that you're the one calculating your probability yourself. In most questions you'll find the examiner will give you the probability of each event, then just multiply the probability by your costs or the number of items, then cost. That will give you the provision you're expected to make. Okay, so believe me, this is an important area of provision. So the remaining thing I need to talk about regarding provision is this. So let me refer to this as, let me call it items affecting provisions. Let me refer to this one as that. Other items that can affect the calculation of provisions. Number one is that in the exam, watch out for time value of money. Okay, so in the sense that the examiner can tell you that we want to spend so much money in the next 5 years, and there's a legislation that requires that we must do that. And I mean, you know that you have to make a provision. So if the period where the liability will crystallize is after 1 year, you have to discount it. I hope you get me. I said if the period when the liability will crystallize is after 1 year, you have to discount the future expenditure or costs to present value. So you need to watch out for time value of money. Another one is future events. This can also affect the amount of provisions you make. The examiner can give you different scenarios about what will happen in the future. If there is a future event that would either increase or decrease your provision, then consider that increase or decrease. Meaning that if, let's say, maybe because of a change in technology, probably they told you that before in the next 10 years, you're supposed to spend a cleanup cost of 100 million. You now say after 2 years or 3 years, then a technology came up that will reduce the amount you would need to spend on that cleanup to, let's say, from that amount, let's say to 500,000. Yes, that means the provision you should then make is now 500,000. It's not that amount anymore. It's not because of future events, changes in technology. So if there are any future event that would reduce or increase the provision, then you need to then adjust. So if there is a future event, like changes in technology, that can increase or decrease the amount of provision, then use the updated amounts. Use the updated one. Also, another one is reimbursables. You know, it's possible that even you yourself that want to spend money, let's say you have taken out insurance with a third party, that they will reimburse you for that amount. That whatever amount you spend, though, they are going to give you back the money. Yes, there are issues around. Are you sure that you will get the money and all of that? So there are criteria for this, which to a large extent is commonsensical in the sense that you need to be certain that you will get the money from the counterparty that is promising to reimburse you. That's one. Two is that the amount you're expecting, don't offset it. Don't offset it against the provision. You present it as a separate asset. Don't go and offset that, okay, the provision is 10 million and I'm getting back 9 million. So let me offset so that I can have an obligation of just 1 million. No, the provision will be kept separate. The reimbursables will be kept separate. So you present it as a separate asset. So firstly is that, so the amount, in fact, the entity must be reasonably certain that it will get the reimbursement before you can recognize it. So, and the amount must not be offset against the provision, but should be presented as what? As a separate asset. Present it as a separate asset for us. And last one is change in provision. Yes, you see, provisions will change every year. Provision will change every year. It can either increase or decrease. So when provision changes, it is the increase or decrease that you capture to P&L. Okay, so meaning that where the balance of the provision increases or decreases, it is the increase or decrease that is recognized to profit or loss, just like the way we do deferred tax. Is the increase or decrease that you eventually recognize to profit or loss. And before we solve some other questions, okay, wait, do you have any questions on this one? Because I want to move to some practical scenarios like that. I just want to give you some examples like that. Do you have any question before I go to some examples? Okay, if you don't have question, let me ask you something. So if you have future operating losses.
Excuse me, sir.
Yes, I thought.
Please, I was just thinking aloud. Don't you think the organization policy can affect provision? I'm just curious.
Okay, let's look at it together. So
Okay.
when you say the organization's policy, so according to IAS 8, right, accounting policies, the organization policy would ordinarily be in line with the provisions of IAS 37. So the policy around provisions will have been, okay, we'll recognize provision when the three criteria are met,
Okay.
and we would measure provision at the best estimate of the future expenditure required to settle the obligation. Their policy on provision cannot be more than that, as far as IAS 37 is concerned. So it won't affect provisions, right? Except, I mean, they just need to comply. That's it for as far as their policy is concerned. Except if you're looking at policy not from the standpoint of accounting policies, but from another way entirely. Which one are you considering?
Okay. Actually, when I say thinking like that, I mean I'm not looking at it from the aspect of accounting, but let's say organizational policy now that they can say we provide that so and so amount of the goods may go bad at certain period. So that's why I was just thinking if the policy of the organization can affect provision, but with what you have explained now, you have likened it to accounting standards, which to me, which is okay.
Okay, so that's the one that would work here because you don't just make policy for accounts. Anytime accountant we hear policy that will affect our reporting, it has to be accounting policy. Any other thing cannot come into reporting.
Okay.
Yep.
Thank you.
You're welcome. So future operating losses. I mean, it means that for looking at your economic activity, looking at your financial performance in prior year and in the current year, you know that you're going to make losses in coming years. And you will make losses. So, I mean, examiner can give you a teaser like this and ask you, let's say the company has estimated that they will make losses of, let's say, 10 billion in the next 5 years. Can he make provision for that? For future operating losses, based on what we have discussed so far? Please, let's interact, because that's what will
Yeah,
make you.
you can.
What did you say?
If it can be reliably measured, I think you can.
But where is the obligation now? Where is the obligation? So when the issue of can he make provision, can he not make provision, the first thing is for you to be able to identify that is there a present obligation? So yeah, there is no present obligation. There is not. Where is the obligation? I can't see the obligation. Or can anyone see an obligation that we have? We don't have any obligation. The thing is that we're not doing well. We make losses. Yes, we make losses. There's no present obligation. So provision cannot be made. Cannot be made on future operating losses. Another one is,
Yeah, when you say future operating losses, you know, is it just based on the operation of the business? Because I know that we can incur bad debt through operation, and then we can provide for bad debt. It's also a loss, is it
oh,
not?
um, we are not proved, taught you that we are providing for bad debt. As of now, you should have erased that from your mind because there is nothing like that. Maybe if you have said provision for doubtful debts, and that one self, I'd even advanced your knowledge when I taught you impairment of financial assets. That's replaced provision for doubtful debts. At the level at which we are teaching you, you should not even be mentioning provision for doubtful debt again. what you should be mentioning is impairment of trade receivables. Just so that you will not think that provision for doubtful debts is under IAS 37. That what we are doing is making provision. And that's why we changed the name. I don't know who came up with that name, but it's a wrong description because it's misleading. So we are not making provision for doubtful debts. It's an impairment of trade receivables because at that point, IFRS 9 applies and say that, we are expecting some credit losses from these financial assets, and we need to categorize it to stage 1, or we need to make a lifetime ECL. I've taught you all of that. So that will not apply here at all. So again, you are going to make losses in the future. Where is the obligation? There is no obligation in line with IAS 37. So we cannot make provision for future operating losses. Yep. Another one is major repairs. I think the explanation for this one goes along with the first one, when you want to make major repairs. So you cannot make provision for it because it's a major repair you want to make in the future. Probably maybe they make periodic repairs on their machine. So before now, people make provision for it. But where is the present obligation? You can decide not to make that repair. So when you then incur that major repairs, yes, you can capitalize that cost as part of your cost of the asset, but don't make provision that there's no obligation. There's no obligation. Another one is the commissioning costs, which is the cost of, you have an asset that you have constructed, and there is a legislation, or even you have created an expectation in the mind of stakeholders that you will remove that items and restore it back to its original condition. So in that scenario, can you make a provision? Who can tell me?
Yes.
Yes, correct. Yes. So there's a present obligation here because is either there is a legislation that requires you to do that, or you have even made a published statement or published policy that you have to decommission. In fact, anytime you see decommissioning cost, just make provision. So provision should be made on the commissioning costs. Another one is restructuring. Restructuring. So restructuring is similar to, let me call it reorganization. It could be expansion. It could be shutting down. It could be change in management. It could be acquisition of a new subsidiary. It could be a lot of things, but it's like there's a change either in the location or in the way you operate. That's restructuring, right? So restructuring can be a lot of things, can be a lot. Now, restructuring is always usually like a plan to a large extent. So see, where restructuring activities have been communicated, because people will be affected, to the affected stakeholders, the entity must make a provision. Because there exists a constructive, because you will have created the valid expectation in the mind of people that you will do something. So something is going to happen. So as far as the structuring is concerned, you would have to make some provisions on that. But if it hasn't been communicated, then there's no need to make any I don't need to make any provision in that regard. Okay. Let's solve some more questions. If you don't have any questions though, you can go ahead and solve more questions. These are past questions here. These are past questions here. I can ask it a lot. It's always there in your exam. So you just need to know the technique of ensuring you get it right. It's always there. And when was the last day they asked it? Yeah, it was their last diet. This was the last diet question. Sorry, can we solve this last diet question before we let's see if we have the ability to solve this. Can somebody read this, please?
Okay, I'll read.
Okay.
The chief accountant understands the guidelines for the preparation of financial statements, one of which is provisions and contingencies. In the course of the preparation of the financial statement, a sum of 200 million naira was captured under this heading. On further investigation, it was discovered that the 200 million naira was made up of the following: 20 million naira for court case involving a supplier, 70 million naira paid for the advertisement rights, 50 million naira provisions for future losses in business operations, and 60 million naira for judgment debt on appeal. Required: 1. Advise on the appropriateness of the amount of 200 million naira captured in the financial statement. 2. Compute the correct amount of provisions or contingencies if the 200 million naira recognized in the financial statement is wrong. 3. Discuss the treatment of the previous entries made in the books to the extent to which the financial statement is wrong.
Thank you very much. So this was how many marks? Just 10 marks. So look at this question. They ask us in the requirements 1, you are asked to advise. So nobody's asking for any calculation. Then number 2, they say compute. Then it's number 2 that you then compute. Number 3, they say discuss, right? You need to do exactly what they're asking you to do. It's very, very important that you get 0. They will give you 0. Like in this one now, you're just calculating. They will give you 0. This one, they will give you 0. This one, they said discuss, you are calculating, they will give you 0. So do exactly what they ask you to do. And it's always very simple. If you follow instructions and keep it simple, simple, simple. They are not difficult at all. You see how simple this one is. So you see that this chief accountant, right? The guy understands guidelines in preparation of financial statements. So and one of it is provision or contingencies. Now, in the course of the preparation of the financial statement, a sum of 200 million was captured under this heading, provisions or contingencies, right? So they captured 200 million. Now, when we investigated further, then we discovered that this 200 million was made up of 20 million for court case involving a supplier, 70 million paid for advertisement rights, 50 million for future losses, 60 million for judgment debt on appeal. So, okay. So is it appropriate for them to put the whole of the 200 million? So advice. So I will tell them, if they say advice 2 marks, I will say 1, to, in order to recognize an item as a provision, the item must meet the following criteria. Number 1, there must be a present obligation as a result of what? Past events. 2, it is probable that an outflow of resources will be required. Number 3, the obligation can be measured reliably. Following from the above, it is not appropriate to capture the entire amount under provision and contingencies. So majorly what gives you the mark is this recognition criteria. That's what earns you the 3 marks that you're looking for, or the 2 marks in this case. Number 2, we're asked to compute the correct amount of provision. So now you say compute. The correct amount of provision. Simple. I look at the components. Number 1, I look at 20 million involving court cases. I'll tell the examiner, note that the amounts captured below, is assumed to have met the 3 criteria mentioned above. So that, because they didn't give me a complete picture, so I can't really say for a fact that they have met the 3 criteria. Number 1 is the court case. I would include that as part of my provision. 70 million. This does not, you cannot make provision for advertisement right now. You cannot make a provision for that. It's more of an asset than a provision. So this cannot fly. 50 million for future losses. I think we discussed this at length in business operation. You cannot make provision for future operating losses. Can't work. There is no present obligation. Also, there is a 20 million There is a 60 million for judgment debts. This one also, yes, you can make provision for judgment debts on appeal, which is how much? 60 million. So the amount of provision you're looking at should be around 80 million. In this case, you're looking at around 80 million. And because the examiner says I should just compute, that's why I'm just computing. I don't want to do unnecessary explanation that will earn me no results. But nobody is asking for that. If they say compute with relevant explanation, I will have explained why and why not. But nobody is asking for that. Number 3, I was asked to discuss the treatment of the previous entries in the books to the extent here. So since I'm asked to now discuss, then I can then go to this one, the 20 million court case, and say the 20 million court case can be recognized as provision if it meets the recognition criteria. So that one is okay. But the 70 million, paid for advertisement rights cannot be recognized as a provision. It should instead be recognized as an intangible asset. It should instead be recognized as an intangible asset, as it will rate or generate future economic benefits for the company. Additionally, future operating losses, where is it? The 50 million recognized as future operating losses where is the requirement again? Okay. Future operating losses should be reversed as there is no present obligation, on this item, and future operating losses cannot be recognized in the books at all. Even it should not even be in the books. Nobody is not allowed to be recognized anywhere in the books. And finally, The 60 million for judgment debt on appeal can be recognized as provision if it meets the three recognition criteria. If it meets the three recognition criteria. And that's the end of that question. If you know exactly what you're doing in the exam, it should not be more than this. Any questions? There's another one this one is a much more difficult one that was asked in 2023. Can somebody read this? Let's solve this one too. Come on, me. Or I4.
Yes, sir.
Okay, let's do this.
Okay, Roman Limited prepares its financial statement in accordance with international accounting standards. On March 16, 2017, Roman Limited made a public announcement of a decision to reduce the level of emission of harmful chemicals from its factories. The average useful life of the factories on March 31st, 2017 was 25 years. The depreciation of the factories is computed on a straight-line basis method and charged to cost of sales. The directors formulate the proposal for emission reduction following agreement in principle earlier in the year. The directors prepare detailed estimates of the costs of their proposals, and this showed that the following expenditure would be required: 60 million naira on March 31st, 2018, 60 million naira on March 31st, 2019, 80 million naira on March 31st, 2020. All estimates were for actual anticipated cash payments. No contracts were entered into until after April 1st, 2017. The estimate proved accurate as far as the expenditure due on March 31st, 2018 was concerned. When the directors decided to proceed with this project, they used discounted cash flow techniques to appraise. Could you please scroll up? Hello?
I've scrolled up.
Okay. I think I'm lost now. Where am I? Okay, the proposed investment. The annual discount rate was 8%. The company has a reputation of fulfilling its financial commitments after it has publicly announced them. Roman Limited has made the provisions for the expected cost of its proposals in the financial statement for the year ended March 31st, 2017. In accordance with the provision of IAS 37, provisions, contingent liabilities, and contingent assets, you are required to: A. Explain the decision of the directors of Roman Limited to recognize the provision in the statement of financial position as at March 31st, 2017, 6 marks. B. Compute the appropriate provisions in the statement of financial position in respect of the proposed expenditure at March 31st, 2017 and March 31st, 2018, 4 marks. Compute the two components of the charge to statement of profit or loss in respect of the proposal for the year ended March 31st, 2018. You should explain how each component arises and identify where in the statement of profit or loss each component is reported. 5 marks. C'est fini.
So this is a very good question. You see that it was asked in November 2023, and a similar question has been asked before. The same question, just that the A part was different for that in May 2021. The same thing. So we'll look at those two questions. Let's look at this one first. So this guy prepares its financial statement in line with IFRS. And on March 2017, they made a public announcement that they are going to reduce the level of harmful emission from their factory. We are told that the average useful life of the factories on March 2017 was 25 years. The depreciation is computed on the straight line method and charged to cost of sales. So the directors formulate the proposal for emission reduction following agreement in principle earlier in the year. So the director prepared a detailed estimate of the cost of their proposal. And this shows the following expenditure will require. So they will spend 60 million next year. I mean, assuming we are in March, of course, we're in March 2017. So this is the end of next year. Another 60 million in 2 years. Another 60 million in 3 years. And he said all estimates were for actual anticipated cash payments. That is not just about making estimate, that they will pay money. They will incur the cost. And they also mentioned that no contracts were entered into until after April 1st, 2017. So the contract only commenced at the beginning of the next year. The estimate proved accurate as far as expenditure due on March 2018 was concerned, when the director decided to proceed with the project. They used a discounted cash flow technique to appraise the proposed investment. The annual discount rate was 8%, and the company has a reputation of fulfilling its financial commitment after it has publicly announced them. So we're now told that this company made a provision for expected cost of its proposal in the financial statement in accordance with, okay. Then the requirement says explain. That's the first part. It said explain. So the first part of the question is for you to explain the decision of the directors to recognize a provision in the statement of financial position, because we're told that the company made a provision for the expected costs of its proposal. Okay. So of course there is an obligating event here, because the company made a public announcement that is going to reduce harmful emission, and they came up with a future cost they will have to incur on that. So, and they have a reputation of fulfilling those commitments. Okay. All of this is just trying to give us a solution to trying to justify that, yes, they can make a provision. So we would need to seriously explain this. So let me sort that out. So for the first part of the question, so the directors are correct, or let me say the entity is correct to make a decision to recognize provision this is because According to IAS 37, provision can be recognized where the three criteria are met. And number one, there must be a present obligation as a result of past events. I'm just intentionally writing it again. Like I'm writing it over and over again, just so that it will stick. You get used to it because you will find it everywhere, every time. Because they need to be sure that you know it. Secondly, is that it is probable that outflow of resources will require settle the obligation. And three, the obligation can be measured reliably. So, from the question, the entity has a constructive obligation and outflow of resources be required to settle the obligation, and it has reliably measured the present obligation. So additionally, the provision, because I'm asked to advise them, so let me advise them. So the provision can be recognized, okay, but the entity must ensure that it is measured at the best estimates. It is measured at the best estimates of the future expenditure required to settle the obligation. And these best estimates will be based on the judgments of the management supported by past experience of similar transactions. Okay, so that's the A part of this question, where they say you should explain the decision to recognize. So of course they can recognize provision. The second part of this question says you should compute the appropriate provision in the financial statement. So the second is asking for computation of provision. Now, you see that this is, we are in 31st March 2017, right? So the question wants us to compute provision for 2017 and 2018. So compute the amount appropriate provision in the statement of financial position in respect of this for this year and this year. Okay, now for the current year, the provision will be determined using present value because these are future estimates that are above 1 year. Future estimates that are above 1 year. So if you do yes, the cash flow, the discount factor at what's the discount rate given? They gave me 8%. They gave us 8%. The discount factor at 8%. Then the PV. Okay, so in year one, I'm spending 60 million. So let's do this. I'm spending 60 million. So can you do 1.08 raised to power minus 1? Anybody? Anyone with a calculator?
0.925.
0.925. Can you do the same thing? 1.08 raised to power minus 2?
0.857.
0.8557. I think they say 925 here. Can you do 0.08? I'll be 1.08 raised to power minus 3.
0.793. 794.
Okay. So even though this particular diet, you are supposed to calculate this, the diet before, they actually give you all the discount factor they give us. So I don't know why they became poorer in how they are setting questions. They should give you, they should not be asking you to calculate. Don't forget the formula is 1 plus how raised to
Power
power
minus 1.
minus n,
That's
abi?
n. Yeah.
Okay. So what's 60,000 times 0.925?
55,500.
55,500. How about 60,000 multiplied by 0.857?
51,
51.
420.
51,
420.
420. What about
Yep.
80,000 times 0.794?
63,520.
63,
520.
520. So what's the total?
170, 440.
170, 440. You see, this is the amount of provision you make in 2017. But in 2018, which is why I say you should be careful from just jumping to dub the questions or the solution in the pack. Anyway, I'll try to solve almost all the past questions in the pack for you from 2020 to last diet. We'll try our best and see if we can, along with some deep IFR question. Their solution to this diet, because when I solved it, one of our students that used that before I told them, stop checking, their solution was wrong for this particular diet. It was wrong, but for this one, they did it the correct way. They did it. I don't know who did this one, and the guy, he got it very wrong, technically wrong. So you see, for 2018, so the provision should be what they did. They just added these two together for 2018. For 2017, they said it's these three. For 2018, no, that's wrong. In 2018, a lot of things will then change. Let me just, in 2018, a lot of things will change because in 2017, it's okay for this one to be year one. But in 2018, this one that was year two in 2017 will become year one in 2018. So this one becomes 60,000. And using the discount rate of year one, it's 0.925. And the year three that was year before becomes, now is year two because we have now moved the year further. And the discount factor we will use now is 0.857. So if I do 60,000, this is 5,500. Can you help me do 80,000 times 0.857?
68,560.
560.
Okay. So what's my provision in
124060?
124060? Where do you think this decrease in provision will go? In fact, I've even made a mistake because I didn't look at the fact that they told us Russian, because this one that was year one before, in 2018 now, they will need to settle it. So this is 2018. This is, let's say this is 0. So the discount factor at 8% for 0 remains 1. So this should be 60,000. So this should be 184,060. 184,060. Hold on. Yeah. So yes, in 2018, this one becomes year 0. This 60,000 becomes year 0. So 1.1. This other one becomes year 1. Why this other one becomes year 2? Then we're looking at a provision of 184,060 in year 2. So, however, the entity will settle the 60,000 because they told us that it's an actual cash that they will pay. That all estimates were for actual, they're actually going to pay it. So those provisions we made in 2017, right, that we did not pay. This was, in 2017, it was just a provision, fine. But in 2018, right, yes, our provision is now this, but we will start paying. We will actually pay, the company will settle that 60,000 because that's when they will incur that 60,000. The 60,000 obligation. Hence, the balance of the provision will be 184,060 minus the 60,000. And that gives us 124,060 after they have settled the provision like that. So for this one now, in my statement of financial position, in March 2017 and March 2018. What's the time? It's already after 5. Let me just, I would do this statement of financial position in our next class. I will update you guys because I have a class now by 5. I don't want to keep them waiting. So we have done the major one. I'll prepare the statement. Just try to look at this and understand it. The next week we would complete it and also look at this 2021 question and see what's different from this particular one. So do you have any questions before I go?
No, sir.
Okay, so you guys go and revise this. I will update you on our plans for our next class. Because I'll be starting my case study classes from September, ending of September. That's when we'll be starting our 7 weeks intensive for case study students, and we'll be having a lot of students that will be joining us, even outside equity, something we would advertise hugely. We want to make it a very good experience for you guys when it comes to case study. So I want to start using Sunday classes for you guys. I've been saying it since the beginning of this diet. So apparently now we have like around 4 or 5 weeks. So I will update you guys again if it's possible for you guys to do 10 to 12 tomorrow morning. If it's possible, yes, we do it. If it's not possible, then we'll move to another Sunday and see hopefully if it's going to be possible. But for now, thank you very much. I'll see you hopefully tomorrow. Bye.
Yes, sir. Bye.
Thank you, sir.